The S&P 500 is down about 1% right now, and it's got everyone wondering, where's the market headed in the near future? And especially as an option seller, should I continue to be running my strategies business as usual? Or is it time to maybe pump the brakes and step away from the market for a bit? In this video, I'm going to break down my reasoning as to why I believe option sellers should still be running their strategies business as usual, even though there seems to be a bit more uncertainty in the market. With the VIX reaching almost 20 today, the threat of tariffs looming, and what's happened recently to the big chip stocks, I can understand entirely how someone would think it's time to maybe lay off of our option selling strategies. But I don't think we've quite reached that threshold yet where we need to be doing that, and I'll explain why. Now, before I jump into the video, you know what I'm pretty sure is unaffected by tariffs? The cost of a Predicting Alpha membership. But also, if you are an option seller and you're looking for some boring strategies to run that actually make money, click the link in the description of this video and sign up for a free trial with us. It's an awesome community. We're doing really cool stuff. And if you're an option seller, I think you're going to love it. Now, with that being said, let's hop over to the computer and take a look at this analysis. All right, so at the time of making this video, VIX is up about 11%. We did see a huge spike where we did touch 20 this morning, which is a pretty high level for VIX. And taking a look at the S&P, at market open, we were down almost 2%. We've rallied back now with some easing of this news around tariffs, and the S&P is down about 0.66%. Now, remember, the reason we're making this video is people are wondering, should we be running our option selling strategies? And I want to break down my logic to you as to why I believe that we should. Now, to do this, I'm going to first come over to the Predicting Alpha terminal. I'm going to go into our education here, and I want to show you one chart in particular, which is this chart here. Now, something important to remember is that when we are running option selling strategies, a fundamental thing we must accept is that we can't actually predict what is going to happen tomorrow. The whole point of running option selling strategies is to try and capture the variance risk premium. The way we think about strategy is that we want to be putting on trades in areas where we know the variance risk premium exists. And by doing that, diversifying across trades and strategies that have it, we aim to extract the average variance risk premium over time. Implied volatility is actually a very good forecast of the future. So on average, we shouldn't really be trying to forecast different than it. We should be looking to measure it. And we want to be trading it at all levels where the variance risk premium exists and our average P&L variance is acceptable to us. So the reason this chart is so valuable is because it shows us, using the S&P 500 and the VIX as an example, how at all different levels of the VIX percentile, the variance risk premium is present. And even more interesting, at all levels of the VIX percentile, the variance risk premium as a percentage of the implied volatility is pretty similar. So whether the VIX is low or the VIX is high, it doesn't make a huge difference in terms of what we expect our average return of selling vol to actually be over a really long period of time. Now, where a difference does come in, though, is our variance of our prediction. So if we look at this, right now, the VIX lower level of the 70th percentile is that 20 mark, more or less, which is where we find ourselves now. So even at the current level of VIX, we find ourselves seeing a positive VRP on average. Now, just to be clear on what variance risk premium is, in this case, we're calculating it as the difference between implied volatility and the subsequent realized volatility. So if implied volatility was 20 and then the stock realized 18 volatility, we would say the variance risk premium was 2 points for that window of time, or 10% of the implied volatility. So the reason this graph is so valuable when we're asking the question, should we keep trading our strategy, is because even though the implied volatility has spiked and we've seen a large realized move today, and there seems to be more uncertainty, we're actually effectively getting compensated for it, right? Built into that implied volatility is a variance risk premium that is on average between 20 and 25% of what the implied volatility is. At the level of vol that we're seeing, with VIX being around 20, there should be about 5 points of variance risk premium embedded into the S&P 500 options, for example. And this is the main reason why I say just keep running your strategies. We are still getting compensated for the risk we're holding, and we can't undo the move that already happened. So the past isn't going to change, but why should we stop running the strategy for the future just because we maybe took a loss on the last trade that happened? When you're running option selling strategies, the game is longer than one trade, and you need to accept that there's going to be hits along the way. Now, a caveat that I want to add is there is a time where I would get out even though the variance risk premium is positive. And that is when there is real panic in the market, meaning let's say the VIX goes above 40. And the reason I would be stopping trading at a point in time like this is because even though there should be a positive variance risk premium, at these levels, we actually do see realized vol tend to stay high for a while. And even though the compensation is positive on average, the the P&L variance that we will experience is at its highest. Meaning if there is going to be a window of time where it is negative, the P&L variance we'll see from that negative window is going to be at its peak. In tests that I've run where I've looked at selling volatility systematically, when I stop trading with the VIX above 40, let's say, I do miss out on some of the biggest winning trades, but I also miss out on the biggest losing trades. On average, it's had a positive impact on the P&L that I've seen historically. And so it's in those windows where I will actually stop running the trade. It's not like I say run the trade all the time. There is a time where you should stop. I just don't think we're seeing that right now. So let's come back over to the computer here and let's take a look at what's actually happening with the S&P 500 to help us illustrate this point. So let's go over to the scanner here and actually take a look at what's happening with the S&P 500 to help us illustrate the point. All right, so here we have the S&P 500 at the top. We see that the price change is 0.66% to the downside. We see that 10-day vol has spiked about 15%. 30-day IV change is up about 2%. So basically no change in the 30-day vol and a spike in the shorter dated vol. We see 10-day IV is up at 89. We see that 10-day IV is up at the 89th percentile, 30-day IV at the 76th. There's some steep skew, and the actual level of vol we're seeing is really not that high, right? 16.5% on the IV for 10 days and 13.86% for the 30-day. So what does this tell me? What this basically shows me is that within the next 30 days, the market expects things to return to a relatively stable level, or at least where we've been in the last week. In the short term, though, the market is pricing in a bit more volatility, which is why we see that the really short dated stuff is spiking in implied volatility, while the longer dated options, not even that far out, right, 30 days out. Now, earlier in the day, these were higher, but it seems that with the news coming out about maybe delaying some tariffs, things like that, the market has started to calm down a little bit. If we go into the data for the S&P 500 here, we can see by looking at the term structure here, between the last 2 days, that it's the short-term options that have really seen this increase, meaning the market is expecting if there is going to be movement, it's going to be short-lasting and it's going to be only in the next maybe 1 to 2 weeks, and then things return to normal. What this indicates to me is that there's going to be this elevated risk premium within the next 10 to 20 days. And as an option seller, you should probably be trying to get a little piece of this. Now, an important thing to note is that you don't want to be going all in here, right? Like by no means am I suggesting that we should be sizing up our trades going into this. But just because we've taken a loss maybe over the weekend where the vol really picked up, the realized vol really increased, remember, the implied vol increase usually follows the larger realized move. So you need to continue trading and you'll actually often see an offset of maybe a drawdown taken earlier due to the increase in implied volatility that happened as a consequence of it. So it's really important to be running these strategies consistently over time, regardless of what the last trade looked like. The only time that I personally look to be exiting these positions entirely is when there's real panic in the market. We're seeing that 4% down day in the S&P, right? We're seeing some crazy stuff. VIX is above like 35 or 40. This is those points in time where I'll maybe say, hey, I'm going to step off the gas a bit here. But VIX at 20, I'm almost always a seller of that. And that's why I'm continuing to run the strategies the way that I do. Some of these concepts are a little bit tricky to talk about, which is why this video might come across a little bit convoluted and a little bit messy. But I hope that I was able to get my main points across clearly, which is that VIX at 20 is usually still a sell. In the end of the day, there's still a variance risk premium that the market tries to price into these options. So I'm curious to know what you think about this analysis and if you agree or disagree with me. So please leave a comment in the video, let me know what you think. And remember, trading is a game that is very long. It's not just about what happens in the last trade, which if you're an option seller, probably didn't go that great this weekend, but it's about what happens over the long term. And that's why we no longer are trying to forecast the future. We're really just trying to measure where the variance risk premium exists and construct a portfolio that allows us to monetize that premium. All right, everyone, that's it for this video. Remember to like, comment, and subscribe. And if you are an option seller, please click the link in the description and get a free trial with us. I look forward to seeing you in the community. All right, everyone, take care and talk soon.